Alright children, welcome back to AP Macroeconomics with your favorite teacher, me, Mr. Kete. Today we're going to talk about closing output gaps, recessions, and inflationary gaps using monetary policy when we have ample reserves. Before we get started, I just want to remind you again, please like and subscribe and tell all your friends to watch my videos. That way I can get monetized. Yeah, why not? Give me money, children. First and foremost, let's just remember how ample reserves work. This is a situation where there's so much money in the banking system that increasing the money supply, like buying bonds, no longer does anything to the nominal interest rate. So instead, to fix output gaps, we're going to have to change what we call the policy rate. And the policy rate is made up of the Fed's administered rates. Those are the interest rates that the Federal Reserve straight up controls. That's the discount rate and the interest on reserves. Remember, the discount rate is the interest rate that the Federal Reserve charges commercial banks to borrow money from the Fed. The interest on reserves is the interest rate that they offer to banks when they leave their reserves or their money in an account at the Federal Reserve. So first, let's look at a recession. Remember, in a recession, our big problem is high unemployment. Too many people don't have a job. Our current output is less than our potential output. My handwriting is terrible. Our current output is less than our potential output, so we have high unemployment. Our goal then is to get people to buy stuff again. We need to increase aggregate demand, and the Fed can do that by trying to lower the nominal interest rate. When the nominal interest rate is low, you have a lower opportunity cost for holding your cash on you. You're not missing out on much interest by not keeping your money in a savings account or something. So we're going to be spending. It also makes it cheaper to borrow, which means more people will borrow money and then spend it. And we're going to lower that nominal interest rate by lowering the policy rate. And we're going to lower the policy rate by lowering our administered rates. If we lower the discount rate, the Federal Reserve charges commercial banks less money to borrow from the Fed. Banks are more likely to lend every last cent that they can because they're not worried about having to borrow money from the Fed. If they lower the interest on reserves, that means they're going to offer banks less interest to leave their money in an account at the Fed, and they're more likely to lend it instead. It's not very lucrative to save your money at the Federal Reserve right now, so they might as well lend it to people like you and me, and we'll go spend it. All of those things will cause the aggregate demand curve to increase and shift to the right. We'll get out of that recession. The unemployment rate will go down as we get back to the natural rate of unemployment, get rid of all that cyclical unemployment. The price level will go up too. Of course, there's going to be inflation when the interest rate goes down and people are spending more money. Next, let's look at how we would fix an inflationary gap. I got erased, but I got it hurt. Now we're going to look at fixing an inflationary gap. Remember, in an inflationary gap, we're producing greater than our potential output. And so our unemployment rate goes below the natural rate and price levels get too high. So our issue here then is high inflation. And in order to fix that high inflation, we, the Fed, need to get people to stop spending money. So we need to decrease aggregate demand. That's the goal. People stop buying stuff, aggregate demand decreases, and prices go down. So what we want to do here is increase the nominal interest rate. Now that the interest rate is higher, the opportunity cost for holding your cash in your pocket is now greater. Every dollar you keep out of a savings account is missing out on greater and greater interest payments. You're incentivized to save instead of spend. Or the interest rate is high and now I don't want to borrow money because I don't want to pay it back because it's going to cost me a lot. All right, we do this by increasing the policy rates, which means we're increasing our administered rates. The Fed will increase their administered rates. They increase the discount rate. When the Fed wants banks to stop lending, they'll charge them more to borrow money from the Fed. Those banks will be less likely to lend every last dollar they're allowed to. At the same time, they'll also increase the interest on reserves. The Fed will offer commercial banks a greater interest rate when they leave their money in an account at the Fed. And if it's in an account at the Fed, then they can't lend it out. So they're incentivizing banks like Bank of America to keep their money at the Fed instead of lending it to people like you and me. Now that that's happened, aggregate demand is going to decrease and shift to the left. Because it costs more to borrow, we're missing out on more interest payments every time we don't save, and we stop spending. That unemployment rate does go up, but we're going back to full employment output and our price level goes down. So we keep inflation from spiraling out of control, we get a little disinflation, and things get better. So that's it, children. That's how you fix output gaps using monetary policy in an ample reserves regime. Next time, we're going to talk about closing output gaps using both monetary and fiscal policy at the same time. I'll see you then. Goodbye.